Let's admit it, option trading at times can seem pretty overwhelming. It does not have to be that way. It doesn't have to be that confusing. And the strategies we're going to talk about are pretty much the building blocks that you should use to get started in options. So first up, we're going to talk about the covered call strategy. And this is where you buy shares of a stock. At the same time, you sell a call option on the very same stock. So by doing this, you are adding a stream of income from the options premium while you potentially gain from the stock's appreciation. So it's a balancing act. You got to choose a strike price that's high enough to provide room for the stock to appreciate, but not so high that the option doesn't sell. So remember, while you gain from the premium, your profit is capped if that stock skyrockets. So let's look at an example here. So let's say you own 100 shares of a company and it's currently trading at $50 a share. So you decide to sell a call option with a strike price of $55, and that expires in 1 month. And to sell this option, you receive a premium of $2 per share, or $200 in total for the entire contract. So now you've collected the $200 up front. So if that stock stays below $55 by expiration, this option will expire worthless. You keep the premium and your shares. Now, if the stock goes above $55, you may have to sell your shares at that price. But at the end, you still profit from the premium and the stock's appreciation from $50 to $55. So that's the covered call strategy. It's the way to earn income on stocks you own while enjoying some gains in the stock. So let's talk about the married put strategy. So pretend you bought shares of a company, but now you're worried about potential losses. So by buying a put option at the same time, you're essentially insuring your stock. So if that stock price falls, since you bought the put option, you can sell at the strike price, and that's going to minimize your losses. Let's say you own 100 shares of a stock. It's $100 each. So now you've invested $10,000 in that stock. So to protect this investment, you purchase a put option with a strike price of $90, expires in 3 months for a premium of $5 per share. That total is $500. So your total investment in this stock is now $10,500. So if your stock price drops to $80, you can exercise your put option and sell your shares at $90 each. This limits your loss to $1,000 instead of $2,000. But if that stock price does climb to $120, your put option expires worthless, but you still profit from the stock appreciation. So again, this strategy is like an insurance policy for your stock, caps your downside while allowing you some upside potential. Talk about the bull call spread. If you're feeling bullish, this might be it for you. And here's how it works. So you buy a call option with a lower strike price. You sell another with a higher strike price. And this creates a spread. So this spread means you're looking to profit from a stock price increase, but you're also hedging your bets to limit potential loss. And this strategy is perfect when you are moderately bullish. So it's a cost-effective way to aim for some gains, but keeping an eye on your risk. So let's imagine you're pretty optimistic about company ABC and it's currently trading at $100 per share. You buy a call option with a strike price of $105. Premium was $5. So at the same time, you sell a call option with a strike price of $115 and receive a premium of $2. So the cost of your purchase call option is $500, right? Since one options contract typically represents 100 shares. And you receive $200 for the call option that you sold. So now your net investment in this spread is $300. So if this company's price rises to $120 by expiration, your lower strike price call option is worth $15 per share. The higher strike call option you sold is $5 per share. You can exercise your lower strike option to buy the shares at $105, sell them at the market price of $120, making a profit of $10 a share or $1,000 in total. Now that's minus your initial $300 investment. So net gain for you is $700. But if the stock price stays below 105, both options are going to expire worthless and your loss is limited to your initial investment of $300. So this strategy lets you play a bullish market, but keeping risk defined. And that's the power of the bull call spread. It's a play for moderate bullishness with really controlled risk. So let's on the flip side here, you're bearish. So now it's the bear put spread. So this one's about buying a put option at a higher strike price and selling one at a lower strike price. So if the stock price goes down, you are now in a position to profit. But just like the bull call spread, your risk is also contained. So this is a move for those that are expecting a downturn, but you still want to keep risk in check. So here's an example. You're bearish on company XYZ, and right now it's trading at $100 per share. So you buy a put option with a strike price of $95 for a premium of $5. At the same time, you sell a put option with a strike price of $85, and that premium was $2. So the cost of your long put option is $500, but you receive $200 from the put option you sold. Your investment is $300. So if this company and its price falls to $80 by expiration, you could exercise your $95 strike put option to sell the shares at $95, while the $85 strike put option you sold may be exercised by the buyer. So your profit is the difference between the two strike prices minus the net premium that you paid. So $95 minus $85 minus the $3, the premium that you paid, that's $7 per share or $700 for the entire options contract. But if the stock price stays above 95, both options expire worthless. Your loss is limited to your initial $300 investment. So this strategy is a pretty good way to bet on the decline of a stock, but keeping your potential losses in check. And these are 4 simple strategies that can help you get started in options. So remember that the key to successful trading in options is understanding the strategies that align with the market outlook and your tolerance for risk. These are foundational techniques for trading options. Understand these, practice these, and you will be on your way to more advanced topics. And if you have any questions about anything options related, reach out to Mike at NetPicks.com. This guy is our go-to for options trading here at NetPicks. If you found this video helpful, please just give us a thumbs up here, maybe share it with some people you know, and subscribe. Any questions or comments, drop them below, and we'll talk to you soon.